program because we are no longer reinvesting. So as a result of that, under the CSPP, we are not reinvesting. We are letting that portfolio into runoff mode. What we have decided is that we will stick to our commitment to be Paris Agreement aligned. And we will, in the course of 23, elaborate the means and the ways by which we will be Paris aligned. I just want to remind you, and this is not to distract me for a second from the fight against inflation, but I just want to call your attention to the massive amount of work that is being done in the supervision arm of the ECB in order to really raise the level of awareness and the level of concern by banks and through banks by their clients. And this is really beginning to work.
Thank you. Turning back to WebEx, I'd like to give the floor to Tom Fairless of the Wall Street Journal. Tom, please.
Hi, thanks so much for taking my question, Madame Lagarde. You say that the burden of proof is in the data for future decisions. What data is it that gives you more confidence that you may be able to pause? And what data will you be looking at, especially over the next months, that would stop those rate hikes? Is it core inflation? Is it more that you're looking at the downturn in the Eurozone economy and concerns about that? And my second question is about the US and the comparison with the Eurozone. The US has raised rates significantly more than the ECB for a similar core inflation rate, or even the Eurozone core inflation rate is slightly higher. The IMF, your former employer, said this week that the ECB might have more ground to cover. Do you agree? Do you think that there is a suggestion that there might be more work to do in raising rates? Thanks.
Thank you, Mr. Fairness, for your two questions. What data will be important? All data. And obviously we will be looking at all inflation data. Starting with headline, we will have 2 readings before our next September Monetary Policy Governing Council. We will look at core inflation, but we will go deeper into underlying inflation numbers to really appreciate and understand what is moving and what is steadily, sustainably moving. We know that some indicators are showing, particularly in the in goods, it's pretty obvious. You look at producer prices, it's pretty obvious. But when you start looking into services in particular, you have to really dissect those that are energy intensive, those that are interest intensive, those that are, interest sensitive, what share of labor there is in various segments of services. So we have to look into all that to understand whether the action that we have determined in the last year and a half now is really having a long-standing impact that will take inflation back to 2%. Don't forget also that we will be looking at the inflation outlook that will be produced by the ECB, which will give us, again, the expected path of inflation, and the readings for 24 and 25 will obviously be very informative for us. We will look at labor numbers, we will look at investment numbers, we will look at just every single parameter of the whole economy of the euro area that we can look at in order to inform ourselves. I know it would be helpful for those who are using the same models, that are playing the same exercise, to understand from us that there is one particular specific indicator, one particular set of data that prevails over the other. No, it is not the case. We're looking at all of it, and expectations are part of the picture as well. The institution that I used to lead, the IMF, has updated its WEO April numbers. And I don't think that any of its terribly talented staff would argue with me that inflation in the United States and inflation in Europe are two different beasts. that are fueled by different drivers, and in a context that is vastly different, both in terms of fiscal, in terms of labor market, in terms of energy. And that certainly has something to do with explaining why figures are where they are. And you know that better than anyone else. The Fed started a little bit earlier than the ECB, and started from a base which was not negative interest rates either.
And the next question goes to Isabella Bufacchi of Il Sole.
Oh no, I wanted to add for Tom. You asked, do we have more ground to cover? At this point in time, I wouldn't say so, because as I said, the data that we just discussed and the assessment of data will actually tell us whether and how much ground we have to cover in September and at subsequent meetings. And as I said in the early part of this press conference, it may vary from one month to the other. Thank you.
Isabella, please.
Sorry.
Good afternoon, and thank you for the opportunity. President Lagarde, I have two questions. One is on this message that you're conveying of the next meeting, that it could be a hike or a pause.
No, next meetings with an
next meetings. And so, compared to what we had up to now, that is 25 basis point hike coming to the next meeting, well, do you have a message to the European citizens that the fight against inflation, you are getting closer to break the back of inflation? There is some good news in this announcement or these comments that you're making. And then the second question, if I may, is on your assessment of the ECB Euro area bank lending survey, because it had some data on demand that was, I think, never seen in the past 20 years. Mm-hmm. And so whether it was discussed at the Governing Council and it had an impact also on today's decision. Thank you.
Yeah, thank you so much. Yes, we are making progress. And I think the good news for European compatriots is that inflation is declining. We had a reading of 10.6% in October. We are now at 5.5%. But is that enough? Is that good as a result? Not quite. We have a target which is medium-term 2%, sustainable, and we want to get there. But I'm sure that people, when they do their shopping, when they fill up the tank, when they pay the gas bill, they see that the increase is not quite the same as 6-7 months ago. But are we satisfied? Are we claiming victory? No. We want to go to the end of the game. The bank lending survey. Yes, we looked at it carefully. It was debated with governors. And if you look at the monetary policy statement in the last, I think it's in the last paragraph that we have, it's very, very significantly described. We say the annual growth rate of lending continued to decrease in June, falling to 3% for firms and 1.7% for households, with annualized growth rate of 0%, completely flat, and minus 0.2% in the second quarter, respectively. So not only are we seeing it very mildly growth year on year, but we're seeing a decline in the last quarter, and the same holds for both corporates and households. So yes, of course, this is one of the elements of transmission that we have seen discussed, and the fall in demand is also obvious, particularly on the part of corporates. A bit less so for households, but on the part of corporates, absolutely, absolutely. Yeah.
Thank you. And this brings our press conference to the end. We wish you a very nice and happy summer, and see you back here for our next press conference on the 14th of September. Thank you very much.
The ECB wrapping up the news conference going into a long summer for President Lagarde and the Governing Council. The next stop, the September meeting. Welcome to the programme, live from New York City this morning. Good morning to you all. Let's work through the price action together on the S&P 500. About 7 or 8 minutes into the session, advancing by 0.8%. The ECB, rather like the Federal Reserve, attempted to retain what many people are calling maximum optionality. The ECB decided to hike interest rates by 25 basis points. Just on the next month, September, that decision could be a hike, could be a pause. At this point, I don't think there would be more ground to cover, but obviously that could change between this meeting and the next based on what data we get between now and then. One key determination for President Lagarde and the ECB to bring inflation back to target, to break the back of inflation, but ultimately we're not in the domain of providing forward guidance. Everything she said in that news conference sounding very similar to what we heard from Chairman Powell in the news conference yesterday after the Fed hiked rates. That's the equity market story. Let's turn to the bond market briefly and work through what's happening in Europe. In Germany, we see a rally. Yields lower by 8 or 9 basis points at the front end of the curve. Similar move over in Italy as well. And in the FX market at the moment, the euro a bit weaker against the dollar. Euro dollar breaking down in and around 110. 110.05 at the moment. We're negative by 0.7%. Here's the ECB chief weighing in on the inflation target.
On the occasion of today, it was a unanimous determination. And the determination is rooted in one very simple direction, 2%. We want to break the back of inflation. 2% is the goal, and we will get there, come what may.
We will get there, come what may. Over at the ECB in Frankfurt, Germany, at the European Central Bank headquarters, Maria Tadeo. Maria, what did you make of that?
Well, Jonathan, in the space of a month, remember, in June, we went from we're not debating a pause, we did not talk about that, to now switching to this is a central bank that keeps an open mind. It is data dependent, but has an open mind, and that means we could, in September, hike or actually go hold. She also said, don't ask me now which way this is going to go, because the burden of the proof, and remember she's a lawyer by training, would be on the data. Remember, there will be new projections in September. So we've switched to we're not contemplating a pause to maybe it's open-minded, keep an eye on the data. And the one definitive conclusion that we got from Christine Lagarde today was the one thing we're not even considering is a cut. So that is the entire 180 that we've seen in the space of a month.
It's not a pause, but it's starting to sound a little more like a pause. Maria Tadeo, thank you. I have to say, following the Fed, focused on the data. Let's get to Mike McKee for the data. Bloomberg's Mike McKee joins us right now. Mike, in the last hour, going into that news conference, the data in America, pretty decent.
Absolutely, John. At least if you're looking forward to a soft landing, Christine Lagarde said the data will tell the ECB what to do. This is already telling the Fed it's going to have to revise its economic projections at the next meeting. GDP comes in at 2.4%. That is up from the first quarter's 2%, and it is much stronger than the 1.8% that had been forecast by economists. It did match the Atlanta Fed's GDP now, so congratulations to the folks down at the Atlanta Fed. Personal consumption a bit weak, 1.6%, down from 4.2% in the first quarter, but business spending way up, 7.7% for non-residential fixed investment. Residential investment not as strong as you'd hope, but if the real estate market comes back, that would help out a lot as well. Durable goods orders, 4.7%. Most of that Boeing, a 69% increase in aircraft orders, but basically there's also strength across the board. Businesses are still investing money. And then, of course, every month, John, we watch the jobless claims numbers, and yet again they drop. 221,000, down from 228,000 the week before. And the number of people who are continuing to get benefits, people who are actually receiving a check, 1,690,000, down from 1,749,000, almost 100,000 fewer people on the jobless rolls. We also got advanced trade, which showed a narrowing to $87.8 billion. So overall, good news pretty much across the board for the economy is still growing. People still have jobs. Now the question is, what is the Fed going to do about its projection that the economy would only grow 1% this year and that unemployment would rise to 4.1%? Both of those numbers in jeopardy.
Yeah, that doesn't look like that's going to happen anytime soon. Mike, just to work through the headlines we got from Chairman Powell yesterday, just on policy being sufficiently restrictive, the FOMC believes monetary policy is restrictive, just not restrictive enough for long enough. Now, Mike, based on the data we've had so far, can you point to the evidence that policy is restrictive enough?
Well, I think we got to wait till tomorrow, John, because we'll see the PCE inflation numbers. When you look at the CPI numbers, they came in significantly lower, as Jay Powell acknowledged. And the Fed wants to see it in their favorite indicator, PCE. We'll get that for June tomorrow. And if we see that kind of progress, then you could argue that maybe it is restrictive enough at this point and just has to be maintained. And of course, the Fed going to be looking at 2 more CPI reports, another PCE report before their next meeting.
Data pretty decent. An hour and 15 minutes ago. Mike McKee, thank you. The economic data out of America, pretty strong this morning. Upside surprise, the right kind of downside surprise on jobless claims again. Yields higher on the Treasury curve. The 2-year up by 3 basis points to about 4.88 on a 10-year this morning. Yields up by 3 basis points or so. To turn to the equity market, about 13 or 14 minutes into the session, advancing by 0.8% on the S&P. Outperformance on the NASDAQ. Outperformance on Meta, getting it done after the close yesterday with earnings. The stock is higher this morning by 8%. Abby has more. Morning, Abby.
Good morning, John, and a very impressive quarter, and more so the outlook. But the quarter that they just reported, they beat both top and bottom line estimates by about 3%. Very impressive is the fact that their revenue growth turned to double digits. Analysts were looking for high single digits, but the growth for revenue grew by 11%, and that's the same deal, even better for the quarter that is right now. Now they are looking for revenue growth of roughly 20% in the third quarter. So that's almost a doubling of what we just had, and they're driven by 34% expansion impressions for the quarter that was, and along with the recovery that they've seen in ad sales. They're really just putting it all together. This was the year of efficiencies, so it was going to be cost cutting, but now we're actually seeing this top line growth. The stock right now, John, up 168% on the year. But interestingly, its price to earnings ratio just 21 times, below the mean of the group around 29 times. So when you put that together with that revenue growth, if they deliver, there is an if there, but that is the expectation, you have the stock heading to its best day since late April, up for a 3rd day in a row.
What a rip-roaring rally, Abby. Wildly unexpected, massive outperformance so far this year. One of the best performing stocks on the S&P 500 through March of 2023. As things stand, the highest since February of last year, February 2022. That stock up this morning by 7.8%. Let's get to the panel. Academy's Peter Chip, Winnie Caesar of Credit Sites. Winnie, I think we put the ECB to one side. We get straight to the Federal Reserve and the economic data from 8:30 Eastern. Winnie, from your perspective, what signs do you see? What evidence do you see that policy is sufficiently restrictive?
Well, I think that the sufficiently restrictive is very much contingent upon real positive yields. I mean, that's a pretty significant point that Powell made during the press conference yesterday, and also much more encouraging from a policy standpoint. Now, a lot of the other data is definitely not supporting the restrictive, but we can't forget just how brutal last year was. We had an awful lot of transition, a lot of headwinds in different parts of the economy, markets down significantly, volatility up much higher. So given how much transparency there has been in talking about policy, talking about where policy is going to go, it doesn't surprise me that a lot of the moves have already played out, and now we're at this kind of lull of a bit more of a Goldilocks scenario.
Pete, are we in the sweet spot, and how long can it last?
Well, I think we can at least focus on earnings, the economic data. The Fed and even the ECB, I think they're going to take a back seat, right? They have very high hurdles to act. They're going to need to see data consistently high or consistently low to do anything. So I think every big macro data point is going to be less important than it was. That should reduce volatility, let people focus on earnings. And today I think it's really exciting that stocks are up, not because of the dovish Fed yesterday, because Meta really delivered. So I think that's what we have to look for is, what's the economy going to look like longer term, and how are earnings coming in?
You published as that news conference was ongoing. You wrote exactly what you've just said. Central banks taking a back seat. You then wrote this. Both are really seriously, honest to goodness, data dependent, referring to the ECB and the Federal Reserve. Pete, how data dependent? And between now and September, what data are they dependent on?
I think that's going to be the neat part, right? Up until recently, they say they're data dependent, but they were looking to either have an excuse to hike or do something. I think they're going to truly analyze this, and they're going to look at 2 months worth of data and see where the preponderance of evidence comes in, as she's a lawyer. But that's what you're going to start seeing is every data point is going to be less important. They're going to look at inflation. They're going to look at jobs. They're going to look at growth. And I think that comes in. I think it's actually going to be steady and maybe slightly declining, which I think is going to turn the Fed at least to the dovish side of things, but not this year. That's a next year story.
So Winnie, let's put some money to work. How much risk appetite have you got right now?
So we have been actually notching down our risk appetite a bit, and that's not because we are all of a sudden bearish on the outlook, but we think that the compression trade in corporate credit has really played out. We are now tight of our U.S. high yield targets. We're pretty much on top of our U.S. investment grade targets for the end of the year, and these were pretty bullish calls just 6 months ago. So we've come a long way really fast, and we like credit for the carry side of things again. In the European markets, we've been a little bit more cautious overall. Yields are lower there. The potential for a more stagflation-y type environment is definitely something that we've been a bit more concerned about. So we're kind of sitting in neutral almost across the board, waiting to see if the fall vol spike that generally tends to materialize actually comes to fruition this year.
The divergence is pretty interesting, Winnie. I'm pleased you touched on it. Pete, if you look at what's happening in Europe at the moment, growth is bad, inflation's still sticky. In the US, growth's still decent for now at least, inflation decelerating, disinflation starting to take a hold. Do you see some divergence emerging here, Pete, between not the central banks, who sound the same in the last 24 hours, but their underlying economies?
I think the underlying economies are a little bit different. Europe's behind us. Europe still has to face a little bit more directly the impacts of the war in Ukraine. So I think they're going to be slower to respond. But over time, I think I'm starting again, what's lagging behind? And maybe Europe's the right place to be, right? If they are 6 months behind us in terms of where they are in their inflation fighting, in terms of what they have to do on the rate side of things, that could be an interesting opportunity. And I was agreeing with Winnie. We kind of like credit. And I started to scale back a little bit last week because, okay, we've had such a good run. But I think after the messaging we're getting, I think credit can go tighter. I think equities can go higher. I think it's going to be the laggards. But you really want to start picking, okay, what's run maybe too much? Obviously, Meta's doing phenomenally today, driving the NASDAQ 100. But I like the laggards. I'm kind of leaning back towards banking, commercial real estate, things I've been cutting my position on. I think we're in a nice little sweet spot for the next month or two.
Peter Schick, commercial real estate, really, is what a lot of people will be asking. Why?
Right after Silicon Valley Bank went under, I think 25 banks must have had emergency calls on how bad commercial real estate is. I think commercial real estate is going to struggle. I think it's going to be very regional, but you are starting to see some pressure to go back to the office, right? As more companies start kind of pressuring work from office, that helps a little bit. And these things take a long time to bleed out, even if there's going to be trouble. So I think people got too bearish. You look at how far down most of these indices are, or the stocks themselves are. I think there's opportunity for a nice little short squeeze still.
So Pete, just to be clear, you mentioned a time horizon. We're talking about a 1 month sweet spot. Is that worth the squeeze?
I think it could be. In this sort of market in August, maybe we go 5-10% on some of those indices, maybe more, right? They're so underweight by so many people, it doesn't take much good news to squeeze those higher. And I think people are looking at the Metas and the quote-unquote Magnificent Seven, and they want to invest in them. But I think if you're going to plow more money to work at this stage, you're trying to plow it into the things that look like they have the most upside and have been most underweight.
You mentioned Meta up 8% right now, the NASDAQ up by 1.8%, Apple as well, looking pretty decent this morning. Close right here, and it's a record high for Apple. If we close at these levels, the stock year to date higher by 51%. We're talking about both the equity market and credit risk here, but just for credit specifically, because that's what you can speak to. What do you think when you hear Peter talking about just the juice worth the squeeze through the next month and being in this sweet spot that you also alluded to?
I think it's a really interesting point, and one of the things that I hear quite frequently from our clients is they went into this year a bit underinvested. Cash balances are still too high. And that, I think, is the most bullish signal that you can kind of find across financial markets. I think this applies to credit. I think this applies to equities. There's been a massive rally across markets, and people still have too much cash. Now the cash drag is not nearly as severe as when, Fed funds is at zero. At least you can get paid a little something for your cash balances. But there definitely is that view that, I've missed out. I just need to hold my nose with this economic data being quite strong, with the Fed being probably near or at the end of its hiking cycle. I just need to get back into this trade.
Winnie, thank you. Winnie Caesar, Peter Schick. Fascinating moment, transatlantic, the ECB versus the Fed. To the two of you, thank you. Thank you again. Just if you look at things at the last 24 hours or so, the Fed and the ECB sound exactly the same. in many ways. But look at the economic data. The backdrop's pretty different. And I just wonder how that evolves in the bond market. Perhaps you get a little bit more divergence, like the divergence we see on the screen this morning, with the German two-year yield lower by 7 basis points and the US two-year yield higher by 4 basis points. Euro dollar backing away. We're down by 0.6% to about 110.12. Let's get you some sector price action. Abby, the rally continues.
It really does, John. The risk-on mood is here, and not surprisingly, as a result, most sectors are higher, led by communication services. That, of course, is Meta, up 3.4%. Right behind it, technology and the discretionary. Those are the three mega-cap tech sectors, the best on the year, all up more than 30 to 40%. Today, rallying, making the day more risk-on. Utilities on bottom. John, here I'm taking a risk, but we're seeing something that we have not seen ever, going back to the Dow's entire history since 1900. We are now up 14 days in a row, just for you, John.
The run continues. I appreciate it, Abby. Thank you. Your trading diary up next. "26 minutes into the session, the data's okay. The Fed's backing away a little bit. Sounds a bit more patient relative to what we heard last year, right? The tech earnings have been decent so far, Meta, Alphabet, and the equity market's doing well. We're up by 0.8%, and many guests are talking to us and saying maybe we're in a sweet spot through the rest of this summer. We'll see. Let's get to the trading diary for the rest of this week. Intel, Ford after the close, rounding out the week with a BOJ rate decision tomorrow. More tech earnings next week. Qualcomm on Wednesday, Apple, Amazon this time next week, and finally, next Friday, it's payrolls from New York. That does it for me. Thank you for choosing Bloomberg TV. This is Bloomberg.
At that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Thursday, July 27th. Here are the top market stories we are following for you at this hour. A tale of two economies. U.S. GDP data blows past estimates with little sign Fed hikes have cooled things off. But the ECB's Christine Lagarde warns Europe's outlook deteriorated and keeps us guessing about September. Meta marches higher. The Facebook parent's results and guidance top expectations thanks to Reels, while they ramp up spending on virtual reality and AI. Shares soar 10%. And spotlight on the SEC. Gary Gensler, the chairman of the Securities and Exchange Commission, joins us in the next hour with his thoughts on AI, climate risks, and yes, crypto. From Washington, I'm Kaylee Lyons with my co-host in London, Danny Berger. Alex Steele and Guy Johnson are off today. Welcome to Bloomberg Markets. Danny, very much looking forward to that exclusive interview in just over an hour from now. But first, we have to talk about the fact that the U.S. data kind of upstaged Christine Lagarde today.
Yeah, at first the euro kind of started to weaken, and then it really went into full force when we got that GDP data. Kaylee, data breaking now on pending home sales that is reinforcing the hawkishness. It is another set of strong data. Pending home sales, let's go through this month over month. It is a rise of 0.3%. The expectation, it was not for a rise, it was a fall of 0.5%. That's much better than the prior month too. Pending home sales had fallen 2.7%. Again, the housing market, it is strong. Now, pending home sales year over year, again, it falls 14.8%. The expectation was for a fall of 16%. So not only is the overall economy doing well, it is also the housing sector. To remind you, Kaylee, and our viewers, the data we got in the past 2 hours that has really switched up the bond market, sent the euro lower, sent the dollar stronger. Initial jobless claims, those came in lower than expected. 221,000. The expectation was for 235,000. Kaylee, just the other one was GDP. That came in at 2.4% rather. The expectation was for 1.8%. And Kaylee, the breaking news continues.
Yeah, it doesn't stop there. We have to talk about the Basel III endgame, Danny. Of course, this is the tightening of regulations to really the tightest they will have been in the aftermath of the financial crisis, or at least a proposal to do so from the bank regulators, the Fed, the FDIC, and the OCC, releasing this proposed package, which, as expected, does include higher capital requirements. For large U.S. banks, with at least $100 billion in assets, they must now face a 16% proposed increase in capital mandates. For the 8 biggest banks in the U.S., they face a 19% boost in capital requirements. This does, in some ways, track with, Danny, the reporting we had already had that it could be something in the ballpark of 20% for those largest banks. We are indeed getting confirmation of that now. Of course, the FDIC is going to be voting on this morning. Then later after this afternoon, the Fed will do so.
Yeah, bad news for bankers from the ECB. We also had the surprise decision to make the remuneration for reserves held with the institution to 0%. You're getting paid nothing for it. Now, for the rest of the ECB conference, let's talk about it, Kaylee, because ECB President Christine Lagarde said officials have an open mind on their next move. Here's some of what she said during the news conference.
Our future decisions will ensure that the key ECB interest rates will be set at sufficiently restrictive levels for as long as necessary to achieve a timely return of inflation to our 2% medium-term target.
For more, let's go to Bloomberg's Maria Tadeo, who's in Frankfurt, who's been monitoring the ECB all day. Maria, I think my favorite part of that press conference was when Christine Lagarde was asked, are you going to hike, are you going to pause? And she says, it's a decisive maybe. What do you make of that response? What do you make of what happens in September?
Yeah, it's a maybe, and the burden of the proof, she repeated that a number of times, will be on the data. Remember, she is a lawyer after all by training. Now, overall, Danny, however, this meeting today, 25 basis points hike as expected, but what really mattered here was that press conference, and it actually did bring about some interesting changes, because if you go back to June, at that point, the head of the ECB, Madame Lagarde, she, suggested, we're going to hike again, so preempted a hike, and also said there had been no debate about a pause. Now, today is a change in script in the sense that they're not really committing to anything going into September. She says they have an open mind, they will look at the data, but it could be a twofold decision. They either hike or actually hold. So that is a significant change from the previous press conference. Again, she repeated and reinstated this idea. It is an open mind. A lot of this will depend on the data, and that is what the European Central Bank is focused on. A number of times she was asked repeatedly, but doesn't mean you will pause, doesn't mean you will hike. And again, she did not really want to flip it either way. The market is looking at this as now they've introduced a pause, so slightly more dovish potentially than expected, but she did not want to tilt one way or another. Insisted it is a maybe, it could be both things, and even, and this is important, if they were to pause or hike in September, it does not point to a sequence. It could change from meeting to meeting now.
All right, Bloomberg's Maria Tadeo, thank you so much. This brings us to our question of the day. What changes between now and September? What could change? Joining us now is Jens Eisenschmidt. He is Chief European Economist at Morgan Stanley. He was with the ECB's Monetary Policy Department right before joining that firm. Jens, thank you so much for joining us with your reaction today. How dovish was this decision, and could it take another hawkish turn before we get to that September meeting?
Yeah, thank you for having me. So I would not think it would be either hawkish or dovish terms. I mean, first of all, we were not surprised by what we heard today. In some sense, the ECB has left behind a string of rate hikes that got progressively also slower. So first 75, then 50, then 25 behind them, and they have entered a new phase. And the new phase is that this is even more data dependent than before. We already sensed that this was sort of a bit the decision in June. In some sense to predict there will be a rate hike, but then from July onwards, it's really up to the data. Now, your question is what could change the decision in either direction. So I think there needs to be clear confirmation that inflation is really on the way down and decisively so. And of course, if you look at core, there is still the services component that hasn't yet peaked, has still some momentum to it. That will be closely watched. The July print here will be very important. Now, between now and the September meeting, you have two more inflation prints. You have the PMIs in August. You have some information on how the second quarter was. And that should get you some idea of where inflation is headed. And that will firmly be the input for the decision in September. Sorry.
I mean, some of the nuances of the shift in language. Last month, they say rates will be brought to a level that is sufficiently restrictive. This decision, rates will be at a sufficiently restrictive level. Do you think Christine Lagarde, the rest of the ECB, has looked at the data this week and have decided rates are indeed restrictive in Europe?
So, I mean, she said in the press conference that the big debate is still there. The big debate is how much of the monetary policy tightening is there in is to arrive in the real economy, and is that sufficient? What we have seen in terms of rate hikes so far to bring inflation back to target. So that's essentially, in a nutshell, the question the Council is facing. I think you can very well come up with a story where you depict the disinflationary path that we have seen so far as largely being unrelated to the monetary policy impulse. So basically, it's something they have hiked the rates to keep expectations stable, and now essentially it's for monetary policy to really work on the real economy. And of course, from that perspective, I would say there the jury is out. That's something that's for sure calls for some caution, and that for sure has been an input in today's decision. I wouldn't think that the PMIs necessarily, so the weakness we have seen early this week, and also the weakness in particular coming out of Germany, was so decisive here. I think the mindset already persisted, but of course, I would say at the margin that could change it. So I would say another set of weak data, survey data, say end August, plus maybe not contradictory signals from the inflation front could get us a pause in September.
Okay, so we're talking about the potential that they don't hike any further, or at least pause in September. But if we're talking about a deterioration in the economic data, Christine Lagarde talking about weaker data in that press conference, and the idea that the near-term economic outlook is maybe a little grimmer, how soon are we going to be having the conversation about the ECB cutting, Jens?
So, I mean, first of all, we expect still on balance a hike of to 4%. In September, but it's a very close call, as you can also sort of see from what I said before. It's really down to the data, as President Lagarde has saying it. Now, we have the first cut in June next year, basically on the notion that the ECB needs to be, have firm evidence there that essentially the economy is weakening. So far, we think they are a bit too optimistic relative to 2024. They have had in their last projections put out 1.5% year on year, which is above potential. We think it will be rather lower. We have 0.9, and I think at some point in that journey, they will sort of come to that realization, say, and if they come to that realization, then that would be one precondition for the cuts. Again, I think you would have to also see, in terms of your own projections, some serious risk of undershooting the target for you starting to be cutting or to be cutting rates again. So we think they can be staying at quite high levels, so 4% for, not quite a year, but 3/4 of a year.
Is the greater risk, though, the balance of risks? I know you want to see more data, Jens, before you confirm any of what we saw in terms of PMIs, lending, that sort of thing. But given that we have that on hand, does it seem like the balance of risks is now starting to shift towards the issue might be leaving things too restrictive versus not hiking enough?
Yeah, no, I mean, clearly, as I said before, I mean, we are leaving a phase where you can easily hike one after the other, so one meeting after the other, coming more to a phase where you have to really see and maybe also let some monetary policy impulse sink in, which would be, for instance, a pause, would be a bit like what the Fed did. Now, in terms of growth, one has to be careful here. I think this is mainly a German story. We do have Germany in recession on our forecast, but the remainder of the euro area performing relatively well, and we have, for some time to come at least, to see that wage negotiations will deliver relatively high wage gains simply as a catch-up process, and that will in itself also feed into inflation. So it's too early on that side to sort of call it a day. So it's essentially a very fine line that the ECB is treating here. And of course, I think they should not overinterpret at that stage, I guess, the PMIs, and I think that's exactly what the conclusion they came to. But of course, it is a further sign to watch this space carefully. Now, the president has said in the press conference they expect this to be short-lived, and they expect a rebound of the economy on the back of essentially consumption, because real income gains are going to come to the consumer, and that will help the consumption that is still relatively depressed in the euro area. So that's the other story that goes against that. So basically, that's exactly why you want to wait it a little bit. But that's also maybe where you want to be more careful and wait for some data to come in.
All right, Jens Eisenschmidt, Chief European Economist at Morgan Stanley, thank you so much for providing your reaction to the ECB today. And coming up, we're going to get more on our question of the day. What changes between now and September, not just for the ECB, but also for the Fed? Emily Rowland, JH Investment Management Co-Chief Investment Strategist, will join us next. This is Bloomberg. right, let's get right back to our question of the day. For the Fed and the ECB, what changes between now and September? Both Jerome Powell and Christine Lagarde in the past 24 hours has said it could be a hike or it could not be. Joining us now is Emily Rowland, JH Investment Management Co-Chief Investment Strategist. So, Emily, we have to combine what we heard from Powell yesterday, saying it could go either way in September, with the data we got this morning, a blowout on GDP, an incredibly resilient U.S. economy. Does it stay that way over the next 2 months?
Yeah, pretty amazing over the last few hours, seeing GDP revised higher, durable goods orders just blowing out expectations. Initial claims at 221,000, that's the lowest level since February. Pending home sales surging. So yesterday, the real caption from the press conference and Chair Powell was data dependent. You know, it was almost as someone was holding up like a giant cue card in the back saying data dependent, and clearly he didn't want to commit either way. You know, based on the data this morning, the odds are still that we see a hold in September, but they've perked up a little bit. There's now a 25% chance of a hike being priced into the bond market for September. So if you're somebody that's pretty data dependent, this morning's data certainly suggests that a hike could be warranted. Still, though, lots to come. We have 2 more CPI reports, 2 more reports on the labor market, so it is a waiting game from here.
Emily, does that mean that if I am an investor, I also need to have a cue card in the back of the room reminding me to trade based on the data, that traders now need to become data dependent?
Yeah, I think so. And I really think for investors, the cue card right now would be, you know, just be careful of going over your skis and taking risk. Some of the economic data, again, has come in positive. The economic surprise index is really elevated right now in the U.S. We're seeing, you know, whiffs of disinflation in the air everywhere, which is something investors are celebrating in addition to better than expected earnings results. So this is a lot of positive sentiment, but we want to be mindful here of the lagged impact of Fed policy and how that's going to impact corporate margins and the economy from here. Remember, we're just lapping those big 75 basis point rate hikes that were in June and throughout the summer of last year. It takes 12 to 18 months for changes in monetary policy to filter through to the economy. So I think it's a little bit soon here to be calling the all clear in terms of adding a ton of risk to portfolios.
Well, to your point on earnings being better than expected, Emily, the average earnings surprise, 5.6%. We're seeing average earnings growth of about 3%. We've thought coming into this earnings season that earnings were going to be down, I think, 8%. So it is a much rosier picture than anticipated. And if we are talking about how the lagged effects are going to kick in, the economy is going to soften, doesn't that mean that the Fed, in theory, would turn to cutting? And couldn't that then help support corporate America in terms of borrowing costs coming down at the same time?
Yeah, absolutely. I think we're a ways away from that right now, though. I mean, we've got Fed policy in restrictive territory, and the way that that impacts companies is that, it causes the cost of capital to rise. So what's happening right now is that you have higher bottom-up costs for companies, and top-line growth is starting to slow. So revenue growth is phenomenal. When we had massive fiscal stimulus, when we had inflation was awesome for corporate profits. And now what you're seeing is disinflation starting to hurt top line growth. Cost of capital is going up. Companies are starting to need to defend their margins. As companies think about maintaining profitability, when their costs go up, they've got to cut costs. The biggest cost to most corporations is labor. That's the point where we'll see the unemployment rate rise. We're not there yet. Companies are telling us that the consumer remains strong. And of course, that's the case because the unemployment rate is low and everybody's got a job, so they're continuing to spend. We're still seeing those margins intact, but we expect that to change as the next couple of quarters unfold, which is a key reason. And by the way, I'm not saying don't be invested in equities. We certainly think you should be, but we want to be looking for higher quality companies, ones that have a better ability to defend those margins, more cash on their balance sheets, better return on equity. And we even think that a baton can be passed to more defensive parts of the market that frankly have been left in the dust as we've seen this big sentiment-driven rally.
Yeah, because part of that, if you had been preparing for a recession, you get a day like today, and those trades just get blown out. You wanted to put flatteners on. Surprise, the curve is steepening. You wanted to go short the dollar. Surprise, it's gaining massively versus the euro. So, what do you need to see to say, okay, I'm not going to get these upside surprises? I feel more comfortable in making that switch to defensive, in making that positioning change to ready myself for a worse economy.
Yeah, it's really initial claims to us, Danny, is the key data point that we're watching. And I think it's a key reason, seeing it come back down to early February levels. We were starting to see claims picking up and it's rolled back over. And as long as initial claims are at these very healthy levels, indicating that the labor market remains really tight, I think it's a bit too early to get defensive here. I also don't think it's right to be, again, reaching for more cyclical, higher beta, areas of the market. We want to be mindful here of taking risk. And we also think bonds can do more heavy lifting in portfolios this year. I know, if you own a 60-40 portfolio, it's out of whack right now. It's about, 67% equities if you haven't rebalanced this year. So I think that there's a nice opportunity here to take advantage of these higher bond yields that have been presented to us. The aggregate bond is yielding close to 5%. Investment grade corporates, 5.5%. We think that there's a nice opportunity to lock that income in as we do see rates eventually go from chopping around here to falling as that recession unfolds. Again, not quite there yet, but the income still looks great.
Emily, really wonderful to get you on what is a very interesting day. Emily Rowland, JH Investment Management Co-Chief Investment Strategist. Thanks so much. Now, still ahead, here's one area of the market, as we're talking about, that has still strong earnings. Meta shares soaring after posting strong results. We're going to have more for you in the startup next. This is Bloomberg.
It's 24 minutes past 7 on the West Coast, so let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Ed Ledlow. And Ed, there's really just one story today, Meta booming. Is this all about Reels?
It's a big part about Reels. The stat that they gave is that the annualized run rate is moving Reels towards $10 billion of revenue. And for comparison, TikTok worldwide did about $9 billion in sales last year. So it raises a really good question, which is Reels, the sort of short form video format, not just driving engagement, but is it actually going to take on TikTok? And it's certainly a question now that we're kind of laser focused on, while still asking lots about AI and the metaverse.
Ed, 30 seconds here. What did you make of his comments on Threads, pouring gasoline on it?
Yeah, look, it's going to be a long time till it makes money. They want to grow it to 1 billion users, but it's obviously a point of interest. And when we speak to the CFO, Susan Lee, in a couple of hours' time, I'm going to ask her, you know, how much inbound have you had? How many phone calls are you getting from advertisers? Because there's interest here. When will it be a real moneymaker? Meta's got a good track record of turning these platforms into moneymakers.
Can you also ask to have something different than just calling it a post on Threads? We need something a little
Right,
bit
what
more
is the lingo terminology? I promise I will.
Yeah, the people demand to know. Ed, can't wait for that interview. That is Bloomberg's Ed Ludlow. And of course, you can catch Ed and Caroline Hyde on Bloomberg Technology in around 90 minutes time. As Ed was alluding to, they're going to be speaking with Meta CFO Susan Lee. That will be at around noon, New York time, 5 p.m. if you are here in London. Coming up, more evidence of the strength of the U.S. economy. We're going to look at those GDP figures and how the Fed staff no longer sees a recession. Jason Furman of Harvard is next. This is Bloomberg.
We are an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the move. So, Abigail, we've digested the Fed and the ECB. And we got to digest that GDP data.
Absolutely. Very positive for sure, Kaylee. And that's one reason that we are looking at something that we have not seen in roughly 123 years. That is the Dow climbing for a 14th day in a row. We keep looking at this. But this really speaks to the broadening of this year's rally. Everybody's asking for breadth. Here it is a little bit, not a huge gain, really taking the stairs up, as they say, but a positive development for sure. Now, if we take a look at the indexes, putting the Dow's gain into the context of the S&P 500, up 0.5% off the highs, but still up. The NASDAQ 100 up more than 1%. Honeywell really weighing more so on the Dow, but NASDAQ 100 and the S&P 500, but really the NASDAQ. Let's take a look at that driver, and of course it is Meta. Now we have the positive from the central banks and GDP, but take a look at this outperformance for Meta, up the third day in a row, up over this time period, up more than 9%. That, of course, on the quarter where they beat estimates by about 3%, importantly putting up double-digit revenue growth for the quarter that was, relative to the expectation of about 8% revenue growth. Most important, though, perhaps, actually, I'll qualify that a little bit, but for this quarter, they're now looking for 20% top-line growth. That's a doubling. This was supposed to be the year of efficiency and cost-cutting. They're doing that, but they're now seeing ad sales help revenue growth, so that's a real positive. If we put this stock into the context of the NASDAQ 100, here is this year's beautiful uptrend. We took a look at this chart, I believe, last week. Today, we're gapping higher. That tells you that investors are surprised by the strength of the Meta quarter and the rally in general, but the RSI still rounding down from overbought territory. At some point, Danny, this index, you will see it go back down toward the trend line as happened in March. But the question is when. These tech quarters reports are coming in much better than expected for the most part.
Doesn't seem like it's going to happen anytime soon, does it? Abigail, thank you so much. That's Bloomberg's Abigail Doolittle. Now, speaking of strength, the U.S. growth in the second quarter surprised. It picked up at a faster pace than expected. In some ways, it's a tale of two economies. The Fed no longer sees a recession, but the ECB at the same time says the near-term outlook for the economy for the euro area has deteriorated.
We have an open mind as to what the decisions will be in September and in subsequent meetings, because this determination based on data might vary from one month to the other.
I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted, and I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting.
Ambiguity seems to be the takeaway from both the Fed and the ECB. If they're data dependent, this is a market that's going to need to be data dependent. So it brings us back to our question of the day. The most important thing, if you're trying to trade these markets, what changes between now and September, the next time we're going to get interest rate decisions? Joining us now is Jason Furman, Harvard University economic policy professor and former chair of the Council of Economic Advisors. Jason, I mean, something feels like it changed from yesterday. Another set of really strong U.S. data. Is this a head fake, or is this an American economy that's headed towards a soft landing?
Look, this is an American economy that is not heading towards a recession anytime soon, or at least not elevated risks above and beyond what you normally have. But we also had 3.8% core PCE inflation this last quarter. So whether it's a soft landing or no landing remains to be seen.
Okay, but as you talk about the fact that inflation is still above target, yet we're not heading toward a recession, it begs the question, what kind of deterioration might be necessary? If we don't get the recession, does the Fed lose the inflation fight? Can they have both?
That's the question. I wish I knew the answer. I am a little bit skeptical still about the possibility of a soft landing. I think it's a real possibility. I still think there's a greater odds that if you don't have, a deterioration in labor markets, that you won't get inflation below 3%, and that the Fed is going to have to come back at some point and do more. I hope I'm wrong. I still think that's where more of the probability is.
And just listening to you talk about that, Jason, I can't help but wonder, are we just in a no man's land here when it comes to modeling, when it comes to past assumptions? The fact we've gotten 500 basis points of hikes few people would have believed that you could do that and not have a recession. Do we just kind of need to start from scratch and throw out a lot of our past assumptions?
I actually think the models work decently well because you have the 500 basis points of tightening. You also had $5 trillion poured into the economy, and that fiscal support operates with long and variable lags. And so some of that money got spent in 2020. Some of it didn't get spent until 2022 or 2023. And so what we've largely seen is a battle between lagged expansionary fiscal policy and contractionary monetary policy, sort of fighting roughly to a draw.
Okay, so I'm glad you brought up fiscal policy because it brings me back to Washington, where I am and where, of course, you've had a history. You've chaired the Council of Economic Advisors under Obama. So as we talk about an economy that doesn't look like it's heading toward recession, consumers that have still spent, according to confidence data, are feeling quite good, yet we still have a president who's trying to tout Bidenomics, and his poll numbers are not reflecting perhaps the strength you'd think they would given where the economy is. What do you think the disconnect is, Jason?
You know, I don't know exactly. Part of it is families had a big blow to their incomes from the inflation. For the last year, they've been digging out. Real wages have been rising, but they're still not back to the place they would have been absent the experience they went through. So that's sort of one possibility. But some is that it's just some sort of vibes disconnected from actual economic performance, where we do have very strong growth, very low unemployment, and real wages have finally been rising again.
Jason, I've said it before, I'll say it again. This is a vibes-based economy. I'm glad a Harvard professor also confirmed that for me too. And of course, when we're talking about fiscal support, it's not just what happened during COVID. It's happening now with the Inflation Reduction Act. If you look at construction spending and manufacturing, it's gone through the roof. How much of that is also fighting what's happening over at the Fed?
I think it really is. You have the deficit has expanded by about 2% of GDP over the last year. Some of the things that were directly targeted and subsidized, like manufacturing construction, as you said, has gone through the roof. But that's partly been putting upward pressure on interest rates, upward pressure on construction costs, and that's why when you look at business investment as a whole, over the last year, it just hasn't done that well. The pockets that are subsidized do well, but it crowds out some of the other areas of business investment, all because it's putting upward pressure on interest rates.
Okay, so Jason, to return to the question about the soft landing or not, you were talking about how fiscal policy operates with a lagged effect, and the same could be said about monetary policy. We were just speaking with Emily Rowland of JH Investment, who was saying we haven't seen the full tightening kicking in yet, and we need to be braced for what happens when it does. What do you think the timeline realistically looks like? And if we do start to see a real deterioration, when is it going to hit?
Look, the near-term inflation data looks like it's going to be reasonably favorable. So my guess is there's nothing that pushes the Fed to move at their September meeting. But if, 6 months from now we still have inflation above 3%, they're going to have a hard time explaining why they're standing pat meeting after meeting. So I think absent a recession, another hike towards the end of this year, another hike or two at the beginning of next year, seems to me quite plausible.
Jason, if I could just quickly get your thoughts on what's happening over in Europe. Is it possible that if we get a hike or two next year from the Fed, as you say, that at the same time Europe could be cutting, considering some of the data?
Yeah, the United States, it's sort of simple. We have strong demand, which manifests itself in strong growth, strong inflation. Europe, it's tough. Their economy has contracted 2 quarters in a row, and they have higher inflation than us. Those are both pulling them in different directions. I think the inflation part of their mandate, which is actually the only part of the mandate for the ECB, the only formal part, is what's going to need to be binding, and they're going to need to do whatever it takes to get inflation down.
And just quickly, Jason, those are the 2 central banks that are now behind us. There is one ahead of us tomorrow, the Bank of Japan. It seems that some think it's a live meeting, that there could be a tweak or even an abandonment of yield curve control. What would the ripple effects, the ramifications be for the U.S. and the rest of the world if that were to happen?
I think it's widely expected to happen at some point. I think it should happen. And so I don't think there'll be very large ripples. I think it's largely been digested.
All right. Thank you so much for giving us your valuable insight today. We really appreciate it. Jason Furman of Harvard University and former chair of the Council of Economic Advisors. Now, coming up, 8 of the biggest banks in the U.S. face a 19% boost in capital requirements. The Basel III endgame is here. We'll have details on the capital rules overhaul on today's Wall Street Beat. This is Bloomberg. Time now for Wall Street Beat, where we look at what is buzzing on Wall Street in the world of banking and finance. And today, we're looking at the most comprehensive overhaul in bank capital rules in years. Joining us now are Bloomberg's Sonali Basak and Michael McKee, who is here with me in Washington. Sonali, just to begin with you, we're talking 19% higher capital requirements for the 8 largest banks, 16% for large banks that are not quite of that gigantic size. In some ways, this is in line with what we were expecting. But what do hikes of this magnitude mean for these banks?
Well, certainly there are higher capital requirements, but I think what you're pointing out here is important, this tiered kind of system here. And remember, lenders between $100 billion in assets and $250 billion in assets, that jump could be as little as 5% or more. But remember, these are banks that weren't previously, say, added to the Fed's stress test, that banks under $250 billion in assets. And you're seeing one ramification here is this inclination of banks to have either a lot less than $100 billion in assets that don't meet these rules, or banks meaningfully above to comply with these rules, to grab some scale so that they can weather this idea of holding more capital against the certain businesses that they're engaged in. I think importantly here is that you've already had a host of banks already react to the idea that trading desks could also face more rules here. And you already have bankers starting to roadmap the types of businesses that might be impacted with, especially the biggest banks, not only almost a 19% increase, but more restrictions when it comes to the trading business, more testing when it comes to the trading businesses as well.
And Mike, I mean, there's more to come today. There's going to be 2 separate meetings from the FDIC and the Fed. What could we expect from those?
Well, the FDIC is considering this proposal that is out now, the Basel III endgame, it's called. It's basically the international banking standards that have been agreed to and updated in recent years. The U.S. has been slow to adopt that. The Fed is going to be voting on that as well, but also some additional regulation and capital rules for banks in the United States. And there'll be a lot of focus on the biggest banks and the fact that they might have a 19% capital increase. But it's really the smaller banks, the ones 100 billion and above, reaction to what happened with SVB and others, that is going to make the most news, because these banks haven't been subject to kind of the same kind of stress test rules that the bigger banks have, and now they're going to have to adopt those as well. And even if they have a small capital surcharge, it means more to them than the big ones do for the larger banks, the GSIBs, the 8 biggest banks.
Yeah, and I've had several analysts tell me, Mike, that this means a lot of these smaller players are going to have to consolidate just to deal with the higher regulatory and compliance costs that they're going to be facing. That said, it is a question of really the timeline here, because as you say, these meetings are happening today. These proposals have come out today, and yet it could be years, right, before they're actually implemented.
Yes, well, I mean, this is the joy of the bureaucracy. They are putting these out for comment now, and comments will be open until the end of November, and you can bet the banks are already submitting their comments about this after Xing out the curse words. And then the agencies have to vote again, and then once that happens, the proposals have a 3-year phase-in for all the banks, slightly different for the larger banks than smaller banks. But the idea, according to the FDIC and the Fed, is this is enough time for them to earn that extra capital. As they earn more money, they can set some aside. And some banks, they say, already probably have enough money set aside that they could just apply it to their equity capital and be fine. So the hope is that it doesn't hit any of these banks too hard. The banks argue it's going to cost them money, it's going to be raising the cost of loans, et cetera, which is what they always argue, but then they do make record profits quarter after quarter. So it's going to be an interesting couple of months of comments on this.
To that point, Shonali, what are you expecting specifically from the critics? I'm assuming you're not expecting any curse words either. What do you think are going to be some of the strongest arguments against this?
We've spoke to some of them already. Think about James Gorman just a week ago, who was talking about the frustration with fee-based businesses being approached here in the new regulatory standards. Remember, a lot of these banks moved to more fee-based businesses because they were less capital intensive. They were able to make more money. These are massive businesses now on Wall Street, wealth management. And what is now happening is the bankers saying, listen, you wanted us to be safer. We are now safer. That is happening through the fee-based businesses. It doesn't make sense to clamp down on those when that movement has potentially made the system safer. That's the argument. There's also this argument here that just because the European banks had been in a weaker position and faced a lot of these rules and had taken a long time to comply, the U.S. banks, the large ones, did not fail since 2008, or had not hit the same types of trouble. In fact, they helped the system this time around. This is, again, the argument. And what they're saying is we don't need to have stricter international standards for the United States banks because we have been able to succeed and be safer. We've also heard the banks already talk about businesses that they might get out of. We talked to the head of the institutional clients group at Citi last week, who talked about certain exotic derivatives and prime brokerage services might be harder to engage in under these standards. But I will also say privately, a lot of these bankers don't believe that a lot of this will see the light of day because of the pushback that this will get in the comment period, and if there is a change in administration in the United States. So a lot of questions about what makes it through, because certainly a lot of these rules are quite severe, and certainly the most severe we've seen in a decade.
Yeah, and on the idea of pushback, we already have seen here in Washington, Republican lawmakers from both the Senate and the House, in advance of these proposals coming out, writing to the Fed saying you need to be very wary of the economic consequence here. Many of them do not like the idea of these stricter requirements coming on capital, et cetera. But Mike, to the point of it's not just about the requirements, but especially in light of the supervisory failures that we saw in the bank failures we've seen earlier this year, it's also cultural at the Fed. And you can change the regulation, but if the supervision doesn't come with it, I guess it's a question of, is this enough to avoid the failures of the future?
Well, you're always fighting the last war, and you will always have lawyers who can design a way around the rules. So this isn't going to be the last word on all of this. But you're right, it's a cultural thing, and the Fed has been on a sort of cultural, I don't want to say warpath, but they have tried very hard to change banking culture and make it more focused on the risks